I wouldn't say building blocks, but the foundations you need maybe to find that 10x stock, that 50x stock, that
Yeah.
100x stock, because there are commonalities to all of them. Obviously,
Yeah.
they're not going to be the exact same. They'll have very different stories, but there are certain elements to stocks that become 100 baggers.
Yeah.
And
Yeah.
I was going to say you should do a bit of a humble brag here, because you're one of the few people that's had multiple 100 baggers that
Yeah, I mean, I'm
I've
very
ever
lucky.
heard from.
It all comes down to one word. I'll tell you one thing. If there was only one word written on the cover of a book with no other words in it, it's temperament. Like,
Yeah.
just buy it and forget about it. Don't get tempted. If it goes up twofold, don't get tempted. If it goes up tenfold, don't get tempted. And I made a mistake by not selling all of my Netflix shares, and now we're just books away from me having my first 1,000 bagger, which is quite unique, I suppose. But anyway, you and we had a good chat yesterday, and we landed on 10 attributes. And once you know what those attributes are, they're hiding in plain sight. You can go and find them yourselves.
This episode of the pod is proudly sponsored by Cadiz Inc. It trades on the NASDAQ under the ticker CDZI. Cadiz is a transformative water resource company that is making a significant impact with its $5 billion in water assets and $173 million in cash. The company is currently constructing a massive water pipeline, the largest in the Southwest, which is designed to ensure reliable water access for the region. Cadiz is actively combating the water crisis with game-changing infrastructure projects and strategic partnerships. Under the leadership of visionary CEO Susan Kennedy, who previously served as Chief of Staff to Governor Arnold Schwarzenegger, Cadiz is set to provide innovative solutions and substantial value to both its shareholders and the communities it serves. Always do your own research before making any investment decisions. The information provided here is for informational purposes only and should not be considered financial advice. Emmett, how are we getting on?
Good morning, Mike. How are things in Biarritz?
Biarritz is mighty. Sun is shining in the middle of December. So, yeah, I can't complain.
Not jealous.
No. Do we have the tiny violins out for Elon? Did you hear the news?
Oh, he didn't get his, what is it, 56 billion, was it?
Yeah, well, so he originally didn't get it, but they've kind of
Yeah.
doubled down. He lost his appeal to get it, I think. So,
Well,
like
yeah, I
it's
saw the
no-go.
news headline and I thought, you know, when you go into the realm of that amount of money, 56 billion, 20 billion, 10 billion, most listeners, most people can't and will not discern between 1 billion in their bank account and
Yeah,
100 billion. Because when you're
it's unfathomable. Like, do you
it's
know what I mean?
unfathomable, you're right.
It's like how far away we are from, I don't know, not the Andromeda galaxy or something. Like, it just
Yeah.
won't compute in our heads. Yeah.
This is true, exactly. I mean, do you remember the show Silicon Valley, or the comedy show from HBO? It was absolutely hilarious.
Yeah.
Do you remember the rich guy? I don't know what his name was. The guy who drove a Lamborghini, and he talked about being in the 3 Comma Club, which was a way of
Yeah.
well,
Okay,
you know, once
yeah.
you're in the 3 Comma Club, I think it doesn't matter whether you get 56 billion or 5 billion. But I do wonder, will it in some way influence Elon's engagement with the very company that he founded or almost founded?
Yeah. I think that's the worry. And that's probably why Tesla kind of, because they did a vote after the first decision saying, look,
Yeah.
we're not influenced by Musk. We want him to do this because he did X, Y, and Z, which is fair enough.
Yeah.
Yeah, because he's got SpaceX now, and he's got, I think more of his money might be tied up in SpaceX than Tesla.
Oh,
Because I think
interesting.
he owns about 40% of SpaceX, which is worth, I think it's worth more than the 200 billion nowadays.
Amazing.
But yeah, look, we won't dwell on him. We spent enough time talking about him. But you're going to set us up first with a little bit on Horizon.
Well, that's true. Yeah, I was going to start by telling our listeners that later today in Horizon, I'm issuing a buy alert for 2 stocks that I already own, but I can't say absolutely convinced, but I am nearly fully convinced they will grow 50-fold in my life. Now, as you know, Mike, 2 weeks ago in Horizon, we did Horizon Live in the Irish Stock Exchange, or Euronext Ireland, as it's now called. And we asked you and Bill Mann and myself to pick 3 desert island stocks. And one of the 3 needed to be a high risk, high reward stock. And I was absolutely knocked sideways to hear Bill, who spoke first, pick the same stock as you, who spoke second, the same stock as me, who went third as the high risk, high reward stock. I was flabbergasted because, as you know, is true. There was no groupthink whatsoever. So I'm going to buy into that stock that all three of us believe has the greatest potential to be humanity changing. And I'm also going to buy another one, which is a virtually unheard of company that exhibits all of the 10 attributes that I think we're going to discuss on this show. And funnily, that second stock is lower risk than the first one I'm going to buy, but I really believe we're looking at a 50 to 100 bagger in the making. So the point is, and sorry, listeners, this is how my Wall Street survives. Subscribe to Horizon today. And what I'd say about this service is it's not for snowflakes. This is a high octane service intended to deliver high rewards. And there's a lot of dead bodies along the way. But we are starting to see some breakthrough. We've got maybe 5 2-baggers in the service now, and we're dollars away from having our first 4-baggers. So anyway, I'll give the name later today in my buy alert of another stock that I'm very confident will be at least a 10-bagger. It's just shot up out of nowhere in our portfolio, and even the CEO believes it's a 100-bagger in the making. So subscribe now before we do something dramatic that makes you wish you signed up for Horizon today. So either go to mywallstreet.com and subscribe for Horizon, or email us at pod@mywallstreet.com. That's pod at mywallst.com.
Okay, there we go. And I think that's actually very on topic for what we're talking about today. So you came up with this idea, and it's essentially kind of, I wouldn't say building blocks, but the foundations you need maybe to find that 10x stock, that 50x stock, that
Yeah,
100x stock. Because there are commonalities to all of them. Obviously,
yeah,
they're not going to be the exact same. They'll have very different stories, but there are certain elements to stocks that become 100 baggers.
yeah,
And
yeah.
identifying that early is key, really. Would you say?
Oh, very much so. Something about 20 years ago, a friend of mine called Kevin Dowling said that every weight loss book, of which there's thousands, I'm sure, was a variation on just 4 words, which is eat less, move more. And, some books advocate eating less of a certain food group, like fewer carbs or whatever. Others lean into how you should move. But broadly, eat less, move more captures the mosaic of more or less all weight loss books. Well, as you said, we thought it'd be interesting to have a conversation to figure out what is our eat less, move more equivalent of stock investing, because there are probably more investing books than there are on weight loss written. I went to Amazon to try and find out how many books were written on stock investing. I did it in the past, and there were thousands at the time, but now it doesn't tell you. And I even went to GPT to try and find out the answer. But the bottom line is, you and I and our listeners, we collectively, as a group of people, have read hundreds of stock and different stock investing books. So we are out, we've an eye on finding businesses that have a higher than average probability of growing into a 50 bagger. So obviously we've been studying and broadcasting and publishing on this subject for over 10 years. And frankly, I've been totally preoccupied with the subject for about 30 years. And I'm pleased to see I have one purchase that's on its way to becoming my first 1,000 bagger, which was
Yeah, I was
uh,
gonna say you should do a bit of a humble brag here, because you're one of the few people that's had multiple 100 baggers that
yeah, I mean, I'm
I've
very
ever
lucky.
heard from.
It all comes down to one word. I'll tell you one thing: if there was only one word written on the cover of a book with no other words in it, it's temperament. Like,
Yeah.
just buy it and forget about it. Don't get tempted. If it goes up twofold, don't get tempted. If it goes up tenfold, don't get tempted. And I made a mistake by not selling all of my Netflix shares, and now we're just books away from me having my first 1,000 bagger, which um uh yeah, is quite unique, I suppose. But anyway, we have landed on 10 attributes. You and I, we had a good chat yesterday, and we landed on 10 attributes that really can't be reduced to 4 words like eat less, move more. But
Yeah.
collectively,
This this is probably a step below that in the weeds. Like, I
it
think
is. Yeah, it
the eat
is.
less, move more would be something along the lines of find quality businesses, hold for as long as you
Yes. Yeah,
as
no,
long as
that's
you
well put.
physically and mentally can. But
There's
this
no
is kind
question.
of the find quality businesses part. Is that fair?
Yeah, that's absolutely very, very fair. I mean, like, what we try to do is create a short list of potential future giants. And when you start as you say, go into the weeds and realize there's just we've put down as 10 attributes. Doesn't mean that if a company has all the 10 attributes we're about to discuss, it's guaranteed for future success, but it puts it on the front foot. And once you know what those attributes are, they're hiding in plain sight. You can go and find them yourselves. So how about I kick off,
Yeah.
Mike, and give the first of 10? And we should probably rattle through them, or else it'll be a very long, boring podcast. But
We're not
okay.
going to go to the history of revenue right now, are we?
Well, actually, funny you should say, because you're right. You are right, because the first of the 10 attributes, Mike, is one that any child would figure out. Anyone over the age of 10 would figure that there is an important attribute in a business that's set to grow, and that's it's growing its revenue. The money in the till at the end of the week, the month, the quarter, the year is more than the same period before it. And there was a very interesting, although very difficult to find, study done by BCG, Boston Consulting Group, and it was Morgan Stanley Research. And they collaborated together for the most expansive, comprehensive study on what is the number one determinant of share price growth over the long term. And the answer, in very short, bottom line, is revenue growth. Now, in the short term, in 1 year, revenue growth is not a determinant, is not a driver of share price performance. And I have a graph here from the study in front of me. In the short term, only 29% of the factor that drives the share price up is down to revenue. But as you widen the lens further and further and further, 74% of the reason a share price goes up over a 10-year period is revenue growth. So basic bottom line, companies that have consistent double-digit or even triple-digit year-over-year revenue growth are early in their growth cycles, and they are destined to create wealth on the whole. And you don't have to look hard to find these businesses. Like, look at the Magnificent Seven, which are, I'm testing myself here, Apple, Microsoft, Alphabet, Amazon, Meta, Tesla, and Nvidia. Those 7 stocks making up the Magnificent Seven are a perfect example, I'm sure, of many of the attributes we're going to discuss, but revenue growth has been so prevalent in those 7 companies that they themselves are called the Magnificent Seven, and everybody knows how their shares have performed.
Yeah, absolutely. And it's just, I think you said it once, once a company can do it over 5 years, over 10 years, that's where the
Yeah,
real
yeah,
payoff is. It's great to see a
it
company that
is, yeah.
maybe usually around when they IPO and they're delivering 40, 50% revenue growth, but that doesn't stick around.
Yeah,
It's
that's
sticking
right.
around part that is really the enduring part. So yeah,
This is
that's
true, yeah.
a very obvious one to start with, but again, very important one. So my one to follow that up is a large total addressable market, or TAM. You hear the word TAM being used a lot, and essentially, like, this is a stock or a business that operates in a market with significant room for expansion. So if you are planning on growing 10x or even 100x, there has to be a market out there to satisfy that ambition.
Mm.
What I love to read in like an investor deck is a company that is growing fast that says something along the lines of, we control roughly 5% of our total TAM right now. Here's how we're going to take more of it. We're superior to this competitor, or we can move into this market, or we're going to go international with this product, et cetera, et cetera. And it's like the showcase of ambition, I guess. Like early Tesla is an example of a small company that had a huge TAM when it first came out, because
Yeah,
basically every car on the road was an opportunity.
exactly, yeah.
So it's a very obvious one. But not only that, when you're looking at TAM, a company with a large TAM is great, but also a company that has the capability of expanding its TAM is also very important, if not even more
Yeah,
important. So as a
yeah.
company develops, its needs are going to change. It might outgrow its original market, which is really common, especially with businesses that start out targeting a niche. So I was looking at Shopify and Paycom, a very similar kind of original ideas, which was business started out by going after small businesses and making a product specifically tailored for them. Now, as those companies got bigger and bigger and they become multi-billion-dollar companies, this original niche became too small for it. So it started expanding and going upstream and taking on like large incumbents like ADP and Amazon for both cases. If they started out by being a direct competitor to ADP and Amazon, these companies wouldn't exist. So
Yeah.
that's an example of a company, two stocks that have been more than 10 baggers, 50 baggers, I'd say, um, that have grown by expanding their TAM as well. So that's a good one to note
It is.
for
I
future
totally
reference. It's
agree.
like,
And I'm like you too. I mean, when I go in and look at the investor relation deck and they usually show a tiny wedge in a pie of this is what we've got and here's where we've left to go. Um, I've seen outrageous TAMs over the past. I remember Matterport was one that
yeah,
struck.
I would always say Matterport. Go on.
It was like $100 trillion
It was
TAM. It was just
it
absolutely
it had
preposterous.
its smack bang in the middle of its investor deck. I
That's
think it
right, it
was
did. I have a
20
question, Mike.
something trillion, the value of all real estate in the world.
And that's our opportunity. I mean,
Yeah.
finding a big number. We can do better than Wall Street. What's our TAM? It's population of Earth multiplied by everything they'll earn in their whole life. Plus,
Yeah, yeah, yeah. Everyone's wealth,
yeah,
everyone's
everyone's
individual
wealth
wealth.
added
That's our
together,
TAM.
plus a multiple, plus a multiple. When you see a TAM, I have a question. So, if a business has a TAM of $1 billion, does that mean it is the total revenue available in a year, or the total revenue available in that sector until the end of time?
I would assume year because it's based on their own revenue. So like if they have 100 million in revenue and they have a 1 billion TAM, they'll say they have a 10% market share.
Yeah,
So
yeah,
yeah.
that's true. That's the way I read it too. But sometimes it's opaque. You're. It's a bit like the Matterport
Yeah.
example there.
It's
That
the value of all real estate that's ever existed. Yeah,
yes, exactly. We want to join the 4 comma club. So,
yeah.
okay. So, I'll take the next one, Mike. So we have growing revenue and operating in a business with or an area with a large total addressable market. Right. The third one again make perfect sense to our listeners, and that's innovation. They've innovative products or services. And as we all know, innovative products and services are essential for companies to grow, because it allows them to differentiate. If you are undifferentiated, you haven't in some way implemented a degree of innovation in your product or services. And ultimately, it opens up new revenue streams and it creates resilience in a landscape, if you like, that's very competitive. And there's probably more books written on the criticality of innovation than there are of investing. And our listeners would have I suppose, a bias towards investing books. But if you go down the rabbit hole of books and investing, for every little book that beats the market, there's a little book of innovation. And that's the truth. In fact, it's a little black covered book of innovation. And for years I read on innovation. It's a very interesting subject. And in fact, there's 7. I'm totally putting myself, talk about listening Magnificent Seven, but 7 types of innovation. Um, Product innovation, which focuses on um, creating or improving goods for better value. There's process innovation, and the real poster child of process innovation. There's a few of them. If you saw that movie about Ray Kroc, the McDonald's movie, The Founder, great movie, where Ray Kroc, when he was improving the McDonald's restaurant formula, he mapped out on a car park with sticky tape how a restaurant should be laid out to minimize the distance a worker needs to move to get, let's say, the pickles onto the burger and the burger into the bag and the bag out to the desk. So that's process innovation. Toyota were held up as a poster child of process innovation way back in the day. And it's basically all about enhancing the internal operations, and every inch of movement saved over the lifetime of a process saves
Yeah.
millions. That's
Yeah.
the second one.
And you can imagine like Toyota with huge
Oh, yeah.
manufacturing plants, how important that becomes. Ryanair, any budget airline which is really trying to save money is the same thing.
Absolutely true. So where physical stuff needs to be done, process innovation is at the core of creating millions or billions in extra revenue if you do it very well. The first, let me see, is product, process, and service. There's service innovation, which is new and improved customer services. And let me think, what's a good example of a service innovation?
Uber.
Uber,
Yeah.
absolutely. Yeah. So then there's organizational innovation, which is about adopting new management practices and structures. Um, There's oh god, I've totally landed myself in a cul-de-sac. There's radical innovation, and then there's incremental innovation. So if you take the iPod, it was a incremental innovation on the Walkman. Or if you take TVs are always used as the example of innovation, where frankly the first television that came into an American or Irish household in the maybe 50s or 60s was a big fat thick cathode ray black and white tube. And then the next wave of innovation was bringing color. And then the next wave of innovation was widescreen cathode ray tubes, these giant TVs that occupied a corner of a living room in most Irish households in the 90s. And then it made them flat, and then it made them 4K, and then it made
Yeah.
them 8K. And so innovations wave after wave after wave. And there's every product ultimately innovates. Some do it very
Mm.
slowly. Like if you take baked beans, like they don't change a whole lot from one year to
Okay.
the
Yeah.
next, but they eventually do. They eventually do. They'll Heinz guys will go, well, we better put in less sugar and make the can easier to open, or whatever. But ultimately, waves of innovation drive differentiation, and that is the backbone of a business succeeding. Because if you don't do it, the other guys will. It's making your stuff better. So that's the third factor that we look for: business that is innovative. And again, looking at the Magnificent Seven, they have all nobody, you don't have to think hard. If those seven businesses innovated, darn right they have. They've
Mm.
utterly changed the way we engage with whether it's electric cars or how we buy stuff at Amazon or Apple's products. They have innovated the heck out of everything that they do. So that's the
Yeah.
third thing.
And multiple layers of that as well. So you'll say
Yeah,
a lot of them started out with radical innovation, but then
yeah,
Apple is the perfect example of incremental innovation, and there's
yes,
brand factors to that as well. But like the iPhone 16X plus Y
yeah,
Z, do you know what I mean? It's like
yes,
it's just a
yeah.
little bit better every time, and it works. But
But
just
you're
with
right.
everything else,
And really, it is just about doing what you do better than the other guys.
yeah,
So it is a better product because we have, and it's a know-how in the business that those fellas over there don't have. So it could be a breakthrough in a drug, or it could be a method, or it could be, as we've discussed, there's so many ways. But every business needs to innovate if they want to differentiate. Now, if you're an electrician working in a community, your service is good enough to get the job done. You don't need to innovate. But if you're going into the bigger picture, innovation is just such an important, it has to be brought into the DNA of a business. And we could do a podcast on innovation because it's a truly interesting subject when you go right back to the roots of innovation and what in fact is it. And like Leonardo da Vinci was a wonderful visionary of how things could be different. And he drew pictures of helicopters and all types of things. But innovation is not just the uh, envisaging, is that the right word? It's not just the visualization of what can be done, it's delivering it. And innovation is not innovation until the product or service is delivered. It has to be
yeah.
available. It can't be just blue sky thinking. Anyway, great
Okay.
conversation. We could keep
I
going.
was about to say, follow that, Mike. You're going from baked beans to Leonardo da
Yeah,
Vinci
I
in
took
about
a
2 minutes.
wild run through the forest of dreams there. Right, Mike, hit us with the fourth one.
Okay, well, I'm actually got the fourth and fifth because they kind of go hand in
Okay.
hand. So, a scalable business model,
Yeah.
and then fifth would be a high gross margin. So, starting with the
Mm.
scalable business model, essentially, to be a high growth stock, you have to have not to be. It's not a mutually exclusive, but it very much favors high growth stocks is low incremental costs for scaling operations. So essentially, especially we see it in software stocks, which have been incredibly popular with investors for the last 20 years. You can build one product, but sell it 100, 1,000, or 1,000,000 times. Do you know what I mean? And the
Yeah.
fixed costs don't really
Yes.
change all that much in that. The
Yeah.
cost of goods sold is very low. It's not like
Yeah.
an iPhone in which there is an X amount of cost of goods sold with every item that goes out. With Salesforce CRM platform, everything is built. You know,
Yeah, that's
there's
right.
no additional
Totally.
cost to give it to one customer as it is to give it to 5 customers.
Yeah.
And if you kind of snowball that factor in, so there's huge advantages to this kind of business model, and they're fairly obvious. I think I've described them there,
Yeah.
but it's been the cornerstone of some truly amazing businesses. I think if we were to call out Salesforce CRM as one, obviously
Mm.
Adobe is probably the OG.
Yeah. Tell me
You
why. Why
know,
is Adobe the OG?
it's kind of one of the original software stocks,
Yeah,
I
it
suppose.
is. Yeah.
So like Photoshop is a perfect example. It would create a version of Photoshop that was essentially the only show in town for graphic designers.
Yeah.
And then it would take a pricey license fee on for every year to
Yeah.
use it. And this model has been built on and morphed into the SaaS model we know today. And obviously Adobe has adopted that since Salesforce were actually the originals to come out with the SaaS model, but very much based on what Adobe did. So it still stands that if you're, and what's very important with this model working is that if you're able to achieve product market fit, and I'm going to get into this in gross margins as well,
Yeah.
um, it makes it so much easier to scale. And then your main expenditure is just going to be basically sales and marketing, which is a great spot to
Yeah.
be in.
It's fantastic. And it's a
Yeah,
very interesting one as well, Mike, because we all know that software is the ultimate scalable business model, whether you're selling subscriptions to an online newspaper or something far more complex, like the examples you just gave there. But then you look at a nice restaurant and you go, oh, this is a great concept. Um, whether it's here in Ireland, Shops is a lovely concept, or Sprout, the other one, and you go in and go, yeah, this is a replicable model. But when you go to scale restaurants, it's so much more difficult, even though it is a scalable business model, to maintain that quality where the founders
100%.
in, yeah, and
You go into
Chipotle,
local producers, all of this. There's so many more
mm,
variables.
yeah,
Whereas, if you're uh, in a in a lab in Palo Alto, you've created this product and it's
yeah,
completely standardized,
yeah,
and a fella in India is going to get the exact same edition as the fella down the road in San Francisco.
that's
And
right.
that's what it makes software companies
It's
what they
perfectly
are, and
consistent. Yeah,
100%. And then
yeah.
I know we're going to get in. So like the exact same elements of that feed into high gross margins for a
Okay,
lot of the
so
time.
that's number five. This is
That's
our
number
fifth
5.
one. Okay, hit me.
Yeah. So like there's an awful lot that can be said, and probably skewing this too much towards software businesses, but it's the most applicable here.
Oh
But
yeah.
essentially, if you have strong gross margins, you can indicate pricing power and more so the ability to reinvest in the company as well.
Mm,
So
mm.
this obviously goes hand in hand with scalability. And again, it's going to be dominated by software business, but not exclusively. Look, if you're a business with high margins in general, like Visa and MasterCard are a perfect example.
Yeah,
They have built a business to such an extent that they have some of the best operating margins, not even gross
yeah,
margins, operating margins in the game. And it's what makes them such attractive stocks. But like, just for an example, if company A and company B are both selling bricks,
yes,
but company B can do it at an 8% gross margin while company A does it at a 6% margin, we know
yeah,
which one is going to end up being more successful. You know, that
yes,
2% on every brick sold will go back into the business, and eventually it'll be able to grow, it'll be able to reinvest, be able to buy more cement, X, Y, Z, build
yeah,
more bricks. Company B goes out of business. Um, and like I've written this for Netflix. I'm not going to tell you the stock, but it was just kind of showcasing operating that kind of operating leverage in real time, I guess,
yeah,
is how I say it. So
yes,
basically, it's this business for Netflix that has incredibly high gross margins, and this is how its kind of operating leverage played out.
yeah,
So since 2009, the company has delivered revenue growth at a CAGR of 30%, while operating expenses have grown at just 5% annually. You don't have to be Einstein to figure out that it's going to help your bottom line. In that 5.5 year period, adjusted profit before tax goes from 36 million, 326 million, with margin
wow,
improving from 25% to 70%. So
nice.
that kind of performance is just mind blowing. And why we
Yeah,
can't, like, obviously, like a 63% CAGR is not going to work ad infinitum. Do you know what I mean? There is a roof on this stuff. Clear that this business model is capable of delivering incredible operating leverage, and that management has seen it as a top priority. So that's why having high margins is an advantage.
oh, it's
We've
huge.
seen them become irrelevant in certain circumstances, and this is when a business, like say we saw it a lot in 2020 and 2021, a business might have a 90% gross margin, but it's forced to spend 80% of revenue on sales and marketing to continue to deliver on this growth trajectory. And
Yeah,
that is a problem of, say, having high margins, but not having that proper product market fit.
yeah, yes,
So, say Adobe had the product market fit with Photoshop because there was no other show in town.
mm,
But then we'll say, I'm not going to call it, but like say something like Monday.com now. Like there are 5 or 6 different public CRM slash like productivity tools out there right now.
Yeah.
And that's a company that's had to spend an awful lot on sales and marketing to keep its growth trajectory. And yes, it's found product market fit, but it's not the only show in town. So that's where it can kind of come across. And we've seen a lot of software companies since 2021 suffer from this of
Yeah.
not really having the exact product market fit. Like, as in, you can have a company selling widgets at a 95% gross margin, but if they don't
Wow.
make any notable difference to the
Yeah.
customer, it's not enough.
Yeah.
So, yeah, I think when we think of scalable business model, high gross margins, probably the third head there would be actually, is it a mission critical product? So
Mm.
is it a Photoshop, or is it a Microsoft Excel, or
Yeah.
is
Is
it
it an
Salesforce? Maybe
indispensable?
Yeah, exactly. Salesforce CRM might be a bit contentious now,
Yeah.
now that there's so many competitors there, but back in the day. So then it becomes an easy win. So I would say to look beyond numbers with gross margins, because there's other elements needed at play to lead to success. But yeah, it's obviously a hugely beneficial aspect to any business.
And it's a little bit more of a nerdy number to get your head around, because when you think about the numbers we've discussed so far, so revenue growth, easy peasy. You can just look at virtually any, you can look at the revenue growth of a business anywhere and you'll understand it. Is it growing 20% or more per year? Simple to understand. Total addressable market. You can ignore it, but you have a good read on it. As you said with the Tesla example, it was all to play for. So you get a fairly good intuitive read on total addressable market by just looking at the business and looking at the world you live in. And then scalable business model, I guess that's less, it is somewhat numeric, but it's also more of a quantitative, or so I mean, say qualitative judgment. But when you get to gross margin, you need to first at least have a rough and ready understanding of what it is. And it's, if a company is making 100 grand in revenue and the cost of goods sold is 60 grand, while the gross margin is 40%, which is 100 grand minus 60 grand. And then the bit that's over there is the percentage, right? So, so
Yeah.
like software businesses, I think the best gross margin business I can recall off the top of my head was a former Horizon stock pick called InMode, which is
No, not Emmet. Was it not Alteryx?
oh, Alteryx had yeah, it was around 80. Yeah, InMode as well. But
Alteryx was
Alteryx,
up in the 90s.
it
Immo,
was up in
sorry,
the
yeah,
nine.
Immo
It was
was
the
at
highest.
85.
But you're right, that's a better example. Alteryx was
Yeah.
the
I
highest
think
gross margin
the
business I think I've
the
seen.
best I've seen is ARM,
Yeah,
you know,
what's that? Oh, ARM. Yeah,
the
ARM. Yeah, exactly. Over
the
in Cambridge.
chip software. I think they
Yes.
have something like 90. I think I saw it was 95% there
Oh, that's
recently.
insane. So for
Yeah.
every $1 million in sales, it only took 50 grand worth of cost of goods sold.
Yeah,
And that,
exactly.
when you hear that, you're like, wow, that's efficient. Very few entrepreneurs have a grasp of their own gross margins. It's funny because every business owner will tell you what this year's revenue was and last year's revenue was and the total addressable market. But when you go to a typical, let's say mid-size or small-size entrepreneur, go to your local restaurateur and go, what's your gross margins? And we're like, what are you talking about? So, it's a bit of a tricky one. Right, I'll push on. I've forgotten where we are. I think we're at number 6, but
6, I think. Yeah.
okay, good. Well, I'm going to talk about one that's pure uh, qualitative. Like, this is pure judgment call. It is not a number report in the balance sheet, and it's visionary leadership. Yet,
Mm.
it is so important. So now, founders are generally the preferred visionary that you like to see in a business, but human beings have only so many years in this mortal coil. So, but what you want is a visionary leader, someone who has proven execution, a strong stake in a company's success. A McKinsey study found that companies with visionary leaders outperformed peers by 20 to 40% in total shareholder return over a decade. And we talk about visionary leaders all the time. We opened this show talking about Elon. We open most shows talking about Elon, who evokes feelings in most people, but he has revolutionized sustainable energy, electric vehicles. Look at Jeff Bezos. How we basically turned Amazon into leader in, well, basically anything. Anytime your doorbell rings, it's Amazon. Well, that's my life. Tim Cook and before him, Steve Jobs, complete visionaries for the Apple ecosystem. Satya Nadella transformed Microsoft into cloud first. These are visionary leaders. The names are all, I'm picking cliches because these cliches are real examples, whether we're talking about Zuckerberg or whether we're talking about Warren Buffett's steady leadership at Berkshire, or Jensen Huang at NVIDIA. These visionary leaders are a key component to the success of that business. And if you were to say, and I've probably said this before in the podcast, but if you were to list the 10 most successful entrepreneurs you can think of, it guaranteed all 10 were visionary. They were probably founders, and they revolutionized an industry. I mentioned Ray Kroc. He revolutionized the McDonald's business. He didn't invent it. It was
I was about to say, not technically a founder. And same with
no more than
Elon at Tesla,
yeah.
yeah.
He bought it, or even Howard Schultz in Starbucks. Like Schultz, as far as I know, bought that. Exactly, but they saw something. They were visionary. They looked at this coffee shop and went, "We can roll this out. I can roll this out across the world." Or you probably start thinking, "I can roll this out across my current state," and then you find, "Wow, this is bigger." So, so visionary leadership. It's a bit like you said in a previous podcast. It's like the Galway accent. You know it when you hear it. Or what's his name, Billy Crystal in Harry Met Sally. I know a good, is it a good pumpkin, or I know a good melon when I feel it. But
I think that was a famous. Oh, I can't remember. It was to do with regulating porn on TV, basically, and
what?
Yeah, it's an old American guy. I can't remember. Was it Walter Cronkite? Some famous old American guy says, "How would you define pornography?" And he's like, "I know it when I see it."
This is true. So all these anecdotes they apply to a great leader. You just know it when you see it. You mightn't like what you see, but a visionary leader is thinking bigger and different. And very often they skew with your own personal sense of values. Anyone who worked with Steve Jobs would have said he was a thorny character, difficult to please, easily offended, fastidious, and all the rest. And it's clear that Elon is his own man. That's all I'll say. But these guys and women who are visionaries generally are at odds with everyone else because they break the rules. But anyway, so that's it. Visionary leader. That's number 6. Let's push on, Mike, or we'll have a record for the longest podcast on Apple.
Yeah.
So that's number 6, Mike. You are going to take number 7. Go for it.
Yeah. So the next one is starting valuation. So I said it's straightforward, but it's not really. Like what's straightforward is if you pay too much for a stock, you likely won't see great returns, especially not in the immediate future. That's a fact. You pay too much, it's not a great investment. It could be a great business.
Yeah, that's true.
Then again, so a lot of big winners are going to start small, be overlooked by the market, and then provide that opportunity for upside as they gain recognition, and especially when the institutional money piles in.
Yeah.
That being said, it is a bit of a gray area when it comes to how to value certain businesses. So if stocks are in that early stage of growth, they might not be profitable or might have just turned a profit.
Yeah.
Meaning the price to earnings ratio doesn't really work. You could then look at a price to sales ratio, but again, it's a dangerous road because you got to take into account an awful lot of factors, mainly the margin profile. So you wouldn't really consider a price to sales multiple of a low margin business. And then you would compare, say, to other people in the industry, obviously. So it really depends. Like fast growing companies with great track records are going to come at a premium valuation.
Yeah.
That's going to be a fact. They have the most potential earning power, so investors want to own them. Simple supply and demand. This is where maybe a PEG ratio could be a way of coming in, where you divide the PE ratio by the earnings growth rate. Peter Lynch said that any stock with PE at the PEG below 1 was a good value.
Yeah.
So this could really mean that a stock, even if it's trading at 50 times earnings, could still be considered good value given its growth rate.
Yeah.
So
I used to always look at PEG. Yeah.
Yeah, 100%. But those 3 examples, I think, show how it's maybe a gray area.
But every giant business was once small, and you ideally want to get in when it's small. There's a very simple way. Like I 2 examples spring to mind from the names that we just spoke about in the last 20 minutes or so. And it's, well, actually, no, we didn't mention Airbnb, but when Airbnb IPO'd, its market cap was, if I recall, it was about 80 to 85 billion dollars. Okay, so
Mm.
that's case example one. Chipotle, a nearly equally well-known brand, when it IPO'd, its market cap was about $1 billion. Now, all of that is like comparing Chipotle to Airbnb is a fool's game. They're as different as two business models could possibly be. However, one started out in the public market at $1 billion in value, the other started 86 billion in value. And I think, to paraphrase what I'm hearing from you, it's nice to get them when they're small because there's a little
100%.
more runway to grow. So we're trying to find small caps grow into giant caps. Like, look at Nvidia, for years sat there in front of all of us doing GPUs for PlayStation 2, and we all ignored it, going, boring. Sure, they're only making chips for PlayStation.
No, it's true. It's true. And then that's another factor as well. But there can also be small caps way
Mm.
overpriced.
Oh, yeah,
Do you know what I
for
mean?
sure.
And then you got to take that into account as well. I mean, it's a tough place to navigate, and it's probably where you need to do the most kind of you need to find your own strategy with this.
You
If you
do.
really want to own high quality businesses, you're going to have to accept that you're going to pay premium multiples for them. But if you're looking for bargains, that might not be the case. You might
Yeah.
look for good way to look at it for me, I think, is to look at, say, the quality businesses trading for below the market multiple. So the
Mm-hmm.
market multiple is the average PE ratio of every company in the S&P 500, and it's at like near record highs or record highs at the minute. But if you're finding, say, Google is a great example. I'm going to use Google twice because another way of doing it is just look at a stock's valuation in relation to its peers.
Yeah.
So Google is sitting at below the market multiple, and it's also the cheapest on a price to earnings basis of the Magnificent Seven as well.
Yeah.
So out of, you mentioned them earlier,
Yeah.
those seven leading businesses in the market, Google, I think, is trading about 23 or 24 times earnings. Market multiple is about 27. Nvidia and Tesla are up at whatever they are. But even Apple is approaching 40, which is expensive by any means. Do you know what I mean? Especially for a business that's growing at Apple's level. So, okay, why is Google the cheapest there? Is there a risk of the regulation of the SEC stuff of being broken up? Or is there another reason? Is it the ChatGPT thing? Is it threat to search? So figuring out why a business is at a cheaper multiple and then capitalizing in it.
That's why where your investigative journalism as aware is really comes to play. Like, I think yourself and Amory did a fabulous job in last week's episode discussing Google's main threat. I think you ended up saying it could ultimately just become an advert exchange if whatever was Chrome is sold off or spun off.
Yeah.
Yeah, I mean, to me, that was an insight that you really can only get when you go under the hood of a business. So you can look at a number, and you can decide, right, the whether it's the PEG ratio or it's a comparison to the overall market, or why is Google or as a business at a lower multiple. Well, then you get under the hood of the business and you realize what those threats are. And I think that you did a very good job at explaining that. It was, as I said, a revelation to me.
Yeah, absolutely. And it just, there's always a reason, whether it's justified or not. Do you know what I mean? So
That's
like,
right.
if
Exactly.
you're looking at a business that's historically cheap in relation to its own valuation, that's another way of, say, finding opportunities.
Yeah.
So First Solar is a great example. Stock I talked about a bit on the pod at the Horizon Live show as well. It's currently sitting at about 18 times earnings, which looked incredibly cheap compared to its 5-year average, about 33 times earnings, about 50% down on the market multiple.
Yeah.
But that 18 times earnings is factoring in what might happen with Trump rolling back the IRA and it taking away tax breaks and subsidies. So
I see.
You can't look, it's a bit like looking at high gross margins and product market fit. You can't look at just one figure in a bubble and be like, this is cheap, I'm going to buy it. It'd be, why is it cheap?
Yeah.
So yeah, that's
very
it's a tough one.
It is a tough one.
You can kind of get caught up in it a bit too much. And especially now when valuations are elevated, it's tough to pull the trigger on stocks as well.
That's right. Yes, it is.
Yeah,
and as
you need to figure it out yourself.
You need to figure, and you said it there, was you need to find To paraphrase what you said, or here's what I took from what you said, you need to find a formula that you are going to apply and stick to it. And if you apply it evenly across all of your investments, well, then it's an even measuring stick being used. Whether it's a meter, a yard, a foot, or an inch, it doesn't matter. You're using the same measuring stick. The one that I've really landed on over the years, and I mentioned I was earlier, a PEG, price to earnings growth ratio, is one I always looked at. I still look at it, but I don't apply as much weight to it. The one I've completely become attached to now because I see true value in it is, and this is very nerdy. And if you're driving your car, please pull in to write this down. It's EV divided by EBITDA, enterprise
Yeah.
value divided by EBITDA, historical training. It shows the business's true value compared to its previous. Oh, look, this is getting so boring. I'll push on. Let's go to the next one.
But it's funny. It's funny because that's the way a lot of M&A would look at things as well.
Yeah, yes, that's right.
Yeah.
Okay, I've no idea. We're on number 8. But we just call it 8. Is it 8? It's
Number
about
8.
8.
I think you've got 8, 9, and then I got 10,
Oh,
and then we're done. I hope.
all right. Okay, 8. So 8 is, what can it be other than significant insider ownership? So when we think about this eat less, move more philosophy that applies to more or less every weight loss book, there is one that you will find in all the investing books, which is insider ownership, which is the key people inside a company have shares in the business in which they're working because their interests are aligned with ours. To people outside the business, they are highly motivated to make sure the share price goes up. And there's tons of research on what's the optimal level. And there was a study in 1988 by Mork, Scheifler, and Vishny, which was kind of the first of its type, which found that when insiders own between 0 and 5% of a company, the performance improves the most because their interests, as I said, are aligned with other shareholders, those outside the business. However, they found when insider ownership goes between 5 and 25%, performance tended to decline because there's this managerial entrenchment and managers can prioritize their own interests over the companies. And then beyond 25%, performance improves again. So it looked like an M curve, if you like. And that study was held up for the longest time as the de facto standard on insider ownership and optimal levels. Now, further studies that I can't find for the life of me, Mike, because honestly, you and I only decided last evening to run this particular podcast, and the study that I always used to hang my hat on, and I still do, is that anything between 5 and 40% is optimal, which is quite reductive based on what I just said. But when you see insider ownership between 5 and 40%, the insiders are highly motivated to make sure it works, but their ownership isn't at a level where the tail can wag the dog. So it's just a logical, it's a purely quantitative number. You can just go, whether you can jump into Yahoo Finance, go into key statistics, scroll down, we'll show you insider ownership. And it would broadly be right. There's other things you can consider what defines an insider. But if you want a quick read on insider ownership, Yahoo Finance is the place to go, and key statistics. So that's 8. Number 9, let me check my diary. Number 9, yes, low competition or high barriers to entry, which generally go hand in hand. And you can do an MBA and learn about operating in a niche market or in a business that's protected by patents or network effect or high switching costs. All of these reduce the risk of being overtaken by competitors, blah, 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 blah. But in essence, a company which we want to invest in businesses with as few competitors as possible. Broadly, like plain and simple. And the way to have fewer competitors is by having something that they can't get. Now, whether it's know-how and how to build an AI chipset or a license that the government has given you, or a toll bridge of which there's only one, or a drug to treat an illness that nobody else has a protection on or nobody else knows how to make and is under patent. But basically what we want is high barriers to entry. And generally businesses with high gross margins have high barriers to entry, or at least they used to. But in the
Well, they have
software world,
such
yeah,
pricing power, so they're able to charge what they
exactly.
want.
This is
Yeah.
true. So it's a simple point. I mean, I'm not going to labor it and beat it to death, but the ninth of the 10 that we have is that you basically have not too many competitors. We look at Apple and go, who's the main competitors to Apple? And after Samsung and Huawei and one, your list is kind of, you're like, oh, who else is like it's an amazing force on businesses. It's an amazing advantage for a business to have high barriers to entry, meaning that the average startup can't just decide they're going to do it. Bill Mann, do you remember a year ago at the Horizon Live event, which was in the Westbury Hotel in Dublin around Christmas time? He said, there's no bunch of kids sitting in a basement somewhere in America figuring out how to start the next Exxon Mobil gas. And it's
Mhm.
like the barriers to entry to that business are impossibly high. Now, there's a bunch of nerds sitting in a basement figuring out how to take down Atlassian or how to take down Adobe or how to do something where they can sit at their keyboard and eat pizzas and give it a good shot. But when you see a business with high barriers to entry, you really can see it. And it's verging on impossible. Money just doesn't make it easy.
Yeah, absolutely. Okay. Last but not least for
Yes.
me, I've got reinvestment.
Yeah.
So this can go a lot of ways. Basically, there's nothing wrong with dividends and buybacks. We do like them, especially in more mature businesses. But to identify a stock that's going to go 10, 50, 100x, these companies are going to be solely focused on reinvesting profits back into the business, into R&D, into expansion, into innovation. And like for hyperscalers, a lot of the success has been when management is their sole focus is instead of looking good on the balance sheet, instead of delivering nice numbers to shareholders, they want to grow the business. Amazon is the perfect example of this. For years, it took forever to turn a profit.
Mm.
Bezos couldn't give a fiddler's
Yeah.
about what the shareholders or the balance sheet or anything else looked like. So he kept seeing opportunities to build out the business rather than just give money back to shareholders in the form of a dividend or a buyback. His tactics saw it build out AWS, its fulfillment network, kind of the scale of the business, its ad network, everything came from that reinvestment. So if there was ever, say, a short-term CEO, or like, I don't say short-term oriented CEO, but someone who wasn't a
Mm.
founder. You're talking about visionary founders
Yeah.
and also someone with high insider ownership who's not worried about losing his job.
That's right.
I don't think we would have seen the same innovation happen. Do you know what I mean? Because
Totally. Totally.
instead of being like, oh, we're not profitable again this year because we spent X amount of money building out AWS, he would have been highly focused on taking, net profit margin from 1% to 4%
Yeah.
because that's what he's judged on. So that's where
Yeah.
it feeds in. And then on the other side of this, you don't really want to see a business not have reinvestment opportunities. So this could be a sign that growth is limited. And a stock we both admire, you already mentioned, Airbnb might fall into this category recently because we've seen the level of buybacks it's doing. So I think it bought $4.2 billion worth of shares back so far this year.
Yeah.
And this is a company with unbelievable cash flow, unbelievable margins. And it's not like a short of cash, but is buybacks the best place for that money right now? Would we not like to see, say, Chesky build out an advertising platform instead, similar to what Amazon's done in terms of the marketplace kind of
Jeez, that's
sponsor
good, Mike.
posts and all the rest?
I'll get you an
So
email. You should send that to him.
that but that's kind of like where reinvestment opportunities are so important for a business to grow, because that's how you build out, not only like do you perfect the business now, but you build out the business for the 10 or 20 or 30 years ahead of it. And that's
Yeah.
what Amazon is such a perfect example of that, and what Jeff Bezos did. And maybe it's a critique of what Airbnb is doing now. Not to say that,
Yeah.
buybacks aren't great, but like
Yeah.
to see the next level of growth, maybe that's what it needs to do. So
True.
that's going to close this out.
It
Jesus, we
is.
said a lot of stuff there.
We said a lot of stuff,
I'm
but guess
tired.
what I did? I wrote it down, and I'm going to say I'm going to read out our Eat Less, Move More equivalent. Although I think you did the best job at the top of the show. But okay, so our Eat Less, Move More equivalent for identifying future 50 bagger stocks is finding companies with strong revenue growth, large total addressable markets, innovative products or services, scalable business models, high gross margins, visionary leadership, under the radar valuation, significant insider ownership, low competition or high barriers to entry, and an aggressive reinvestment in growth. And that is a formula for discovering future giants hiding in plain sight, which I have dedicated my life to doing. Sign up for Horizon, folks. That's what I do all the time, and that's what I'll do until the end of my days. So, as I said, I've actually morphed this back into an advert. I am buying 2 companies today that fit the bill on these 10 bullet points. And I mean, you can never say I'm sure they're going to grow 10, 50, 100x, but you know what? I'm putting my money where my mouth is, and I'm pretty sure, and I have a moderate to good track history on finding a few of these.
Brilliant. Okay, well, we'll leave it there, so, because I'm wrecked. I'm sick of hearing myself talk.
Yeah, sure. God.
Emmett,
Imagine how we
thank you for
feel.
joining me.
All right, Mike. Thanks, Mel.
Emmett, thank you for joining me, and thank you everyone for listening. We will talk to you next week.